Merck has fallen by 41% from their all-time high, giving them a trailing PE ratio of only 11.5 and a dividend yield of 4.1%, which is near a 10-year high for Merck. But is the market mispricing Merck stock, or are there valid risks worth avoiding? Today's video will be an in-depth analysis of Merck stock, covering business operations, fundamental, and technical analysis. Merck is a global pharmaceutical company originally founded as the Merck Group in Germany, but in its current form it operates as Merck & Co. and is headquartered in New Jersey. Merck currently operates in 154 countries, and by revenue, it's one of the largest pharma companies in the world, with $64 billion in revenue as of fiscal year 2024, with 50% of their revenue coming from the US, 22% coming from Europe, the Middle East, and Africa, 9% from China, 5% from Latin America, 5% from Japan, and another 5% from a group titled Asia Pacific. And lastly, 4% of revenue comes from a segment titled Other, which is comprised of miscellaneous corporate profits and third-party manufacturing arrangements. So by geography, they are fairly well diversified, especially considering that many pharma companies derive an even greater proportion of their revenue from the United States. In terms of the types of products Merck sells, this is where their diversification stops, which we can see through the revenue distribution by product, which is dominated by their cancer-fighting treatment Keytruda, which makes up a whopping 46% of their revenue. And the only other single product that is also a prominent contributor to revenue is Gardasil at 13% of revenue, which is an HPV vaccine. And lastly, the segment Animal Health makes up 9% of revenue. Otherwise, no single product contributes significantly to their total revenue. Since their revenue is so dependent on Keytruda, that makes the patent expiration all important, which is expiring in 2028 in the US, and the US makes up the majority of Keytruda sales. Outside of the US, Keytruda expires in 2031 in Europe, 2032 to 2033 in Japan, and 2028 in China. Merck's next largest products by revenue, the two types of Gardasil, are either already expired, or with Gardasil 9, it's expiring around the same timeline as Keytruda. So once Merck loses patent protection for these major products, Keytruda and Gardasil, their revenue will likely become a fraction of what it is today. But what other products does Merck have in its pipeline that could save its future revenue? Well, they have two products that are in the final approval or denial stage with the FDA, and all of these products that are in the final phase of development before they are to be reviewed and approved by the FDA, which is phase 3. I'm not a pharma expert, but I would guess that any of these products could be a blockbuster or a total flop, and we won't know their value until they've reached the public market. Now let's cover the macro level pros of Merck's business. This is going to be a fairly short segment, but the first business advantage that pops into my mind is that Merck creates medicines not just for humans, but for animals as well, through their animal health segment, which accounted for 9% of revenue in 2024. I see this as a positive since it creates diversification from a species level, and the animal pharma space is quite consolidated, having very few major players, making Merck the second largest animal pharma company by revenue globally. Another macro level business advantage to Merck and pharma companies in general is that they produce intellectual products that are relatively small and cheap to distribute across the globe, which is partly what leads pharma businesses to have such high operating margins. And in the case of Merck, their most recent operating margin is at 38%, which, for reference, is better than Apple, who has an operating margin of 32%, which is also quite high for any company. Despite pharma companies like Merck offering some high-level business advantages, there are some serious risks to consider. The most prominent in Merck's case being that 46% of their revenue comes from a single product, Keytruda. And when the patents expire for Keytruda, we won't know how much revenue they'll be able to generate beyond the patent cliff. And worse yet, Keytruda is the greatest growth driver for Merck of any product, having produced $21 billion in revenue in 2022. And in 2024, it produced just shy of $30 billion, an increase of 41%. Outside of Keytruda, their revenue growth and shrinkage is mixed across various products, with all the products or segments highlighted in green growing over a 2-year period, and all of the items highlighted in red shrinking over a 2-year period. In general, this revenue and revenue growth dependence on Keytruda is a major risk and is likely the reason why Merck stock has been trending down lately. Another risk with pharma companies in general, including Merck, is product liability, like with Gardasil, for example, which has led to Merck currently having 225 court cases filed against it, due to unforeseen side effects. This may or may not lead to serious financial repercussions for Merck, but with every new product Merck produces, it runs the risk of being a massive liability. Now let's get into the foundation of the business, starting with revenue. Since 2015, Merck's revenue went through about 6 years of stagnation, followed by a meaningful growth phase beginning in 2021, giving them a 10-year compound annual growth rate of 5.0%, which looks to be about in line with the revenue pattern of the pharmaceutical sector in general, as seen through the pharma ETF, PPH. In terms of free cash flow per share, Merck's results have been inconsistent, although trending up, with a CAGR over this period of 6.0%, slightly outpacing revenue growth. The next metric we have is shares outstanding, which to me is always a general indication of financial wellness. Merck doesn't really stand out here, having reduced their share count by a CAGR of only 1.1%, and recently, their share count has been flat. But some share count reduction is better than none. Another all-important metric to consider, especially while interest rates are high, is total liabilities plus cash and equivalents compared to free cash flow. Merck is doing well by this measure with a total liabilities level to free cash flow of just 3.4 times, which I think is quite low for any business. In terms of valuation, Merck is trading at an objectively low multiple, at a trailing price to cash flow of just 9.5 times, which is a 41% discount compared to their own 5-year average of 16.2. Or if we looked at the trailing PE ratio, currently at 11.5, compared to the pharma ETF, PPH, at a PE of 23.8, Merck is also trading at a significant discount to its peer group. I think Merck is currently a value stock, but their dividend may be enticing for someone who believes in their growth beyond their Keytruda patent expirations. Merck offers a current dividend yield of 4.1%, which is quite high, especially compared to their own 5-year average yield of 3.0%, a difference of 36%. And better yet, if we looked at their yield over the past 10 years, it has never been this high over this entire period, which indicates relative value, and that the market has priced in significant risk. This graph of the dividend yield over a 10-year period is a feature that I love about Seeking Alpha, and if you like it too, I have a link in the description that will get you 20% off the premium price while this sale lasts. In terms of dividend growth, their dividend has grown fairly consistently, at a 10-year CAGR of 6.5%, a 5-year CAGR of 7.1%, a slightly slowed 1-year growth rate of 5.4%. And better still, they have an uninterrupted dividend streak of 54 years without a reduction, which proves that they've been able to continually sustain their dividend despite going through product cycles of development and patent expiration, although their dividend growth has only been sustained for the last 13 years. Dividend history can be informative, but I think the payout ratio is what truly determines dividend safety. In Merck's case, they have a trailing 12-month payout ratio of 46%, based on free cash flow, and an average payout ratio over the past decade of 68%. So their dividend would appear sustainable if it weren't for Merck's dependence on Keytruda and the looming patent cliff. In summary of the fundamental analysis, I think Merck is trading at a value based on the current price to cash flow ratio and relatively high dividend yield. But Merck's revenue will likely collapse when the Keytruda patents expire, and it's anyone's guess if they'll be able to develop new medicines to compensate for that, and if they'll be able to pay the same dividend throughout this cycle. Let me know your thoughts on the future of Merck and their dividend. Here we see Merck over a 5-year time frame, and the first feature I notice is that their stock has gone basically nowhere, with a price return of just 3%, which explains their high dividend yield and low valuation. The next element of relative value to notice is the current price in relation to the average price over this period, shown by the center yellow standard deviation channel line, with the average price being $114, while the current price is just $79, meaning Merck is trading at a discount of 31% compared to the average price. In terms of support and resistance, price looks to have held this support level around $72 and is currently facing resistance around $81. And we'll have to wait and see where price goes from here. At the bottom of the chart, again we see relative value, shown through the Relative Strength Index, or RSI, which is near the bottom of the range, currently at 38.4. with the midpoint of this range at 50. One final factor that will likely influence the price of Merck is the S&P 500 and what it decides to do next. Currently, it looks like it's shaping up for a rejection around recent highs of $613. And if it does get rejected, this will probably push down the price of Merck with it. That's all I have for Merck stock, but if you're looking for another in-depth analysis of a stock that's trading at a relative discount, check out this video covering Chevron stock.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.